In the crash of 1929, one brilliant young money manager watches his fortune get almost completely wiped out. Over the next 3 years, he loses about 70% of everything he and his investors own. Most men would have quit Wall Street forever, but he does the exact opposite. From that ruin, he builds a complete system of investing that will outlive him by a century. His name is Benjamin Graham, and he is the man who invented value investing itself. And one day, a young student named Warren Buffett will call him the second most important man in his life. Benjamin Graham is born in London in 1894, and his family moves to New York while he is still a baby. When Graham is just 9 years old, his father dies, and the comfortable family is plunged into poverty. His mother loses the family savings speculating on stocks with borrowed money in a market panic. That early lesson in the danger of reckless speculation burns itself into the young boy forever. Graham is a gifted scholar, and he wins a scholarship to the prestigious Columbia University. He graduates near the top of his class at just 20, and 3 different departments offer him a teaching job. But he needs money to support his family, so he chooses Wall Street over the quiet life of a professor. He turns out to be brilliant at it, spotting cheap, overlooked stocks that almost everyone else ignores. By the late 1920s, Graham is running a successful investment partnership and is genuinely rich. Then in October 1929, the entire stock market collapses and the Great Depression begins. Even Graham, a careful investor, is caught in the carnage and watches his fund collapse. From 1929 to 1932, his partnership loses around 70% of its value, nearly destroying him. He works for years without pay to earn back every dollar he had lost for his clients. The second leg of the crash in 1931 and 1932 is even crueler than the first and nearly finishes him off. By the very bottom, the American stock market has lost almost 90% of its total value from the peak. Graham realizes that raw brilliance did not save him because the old way of investing was really just gambling. Most investors back then bought stocks on rumor, on hot tips, and on borrowed money they could never repay. Nobody, he sees, was actually studying the real businesses hiding behind the ticker symbols they traded. So Graham decides to build a true science of investing from the ground up, grounded entirely in hard numbers. And out of that brutal experience, he asks one question that will change finance forever. How can an investor buy stocks in a way that protects him, even when he is wrong? In 1934, Graham and his partner David Dodd publish a 700-page book called Security Analysis. It becomes the founding text of value investing, and it is still studied closely almost 90 years later. Its central idea is deceptively simple. A stock is not a lottery ticket, but a piece of a real business. Every business, Graham argues, has an intrinsic value based on its real assets and earnings. The market price, however, swings wildly above and below that real value all the time. Graham's genius is a rule he calls the margin of safety, the single most important idea in all of investing. Only buy a business for far less than it is truly worth, so that even your mistakes still leave you safe. To explain market madness, Graham invents an unforgettable character named Mr. Market. Imagine a manic business partner who shows up every single day and shouts you a different price. Some days he is wildly optimistic and offers you a fortune. Other days he panics and almost gives it away. You are never forced to act, Graham says, so simply use his madness instead of catching it. Buy from Mr. Market when he is terrified and sell to him when he is greedy. Graham then gives us his most famous line of all about how the market truly works. In the short run, he says, the market is a voting machine driven by raw emotion and popularity, but in the long run, it becomes a weighing machine that finally measures a company's true worth. He also teaches investors to hunt for what he calls net-nets, the ultimate hidden bargains. These are companies trading for less than the cash and assets they could sell off tomorrow. Buying them, he says, is like picking up a dollar bill lying on the ground for just 40 cents. Graham splits all investors into 2 clear types: the defensive and the enterprising. The defensive investor wants safety and simplicity, holding a steady, broadly diversified portfolio. The enterprising investor does the deep, patient work to hunt for the bargains the crowd has missed. But both types, he insists, must first master the one enemy who never, ever goes away. The investor's chief problem, Graham warns, and even his worst enemy, is likely to be himself. Fear and greed, not the market, are what quietly destroy most people's wealth over a lifetime. His own partnership with Jerome Newman goes on to average around 20% a year for 2 decades, and his classroom produces a whole generation of legendary investors far beyond just Warren Buffett. Students like Walter Schloss and Bill Ruane carry his methods forward for over half a century. Graham proves his rules work not just on paper, but in the real hands of real disciplined people. In 1949, Graham distills his philosophy for ordinary people in a book called The Intelligent Investor. Decades later, Warren Buffett will call it by far the best book on investing ever written, because all the while Graham is also teaching finance at Columbia University. In 1950, a 19-year-old student from Omaha named Warren Buffett walks into his class. Buffett is the only student Graham ever gives the highest possible grade of A+. Graham later hires Buffett, and the young man absorbs every principle his hero will teach him. But Graham's single most profitable investment actually breaks one of his own strict rules. In 1948, he pours about a quarter of his fund into a single insurance company called GEICO. He normally preaches diversification, yet this one concentrated bet violates that very rule. Over the years that follow, the GEICO stake grows to be worth more than his entire fund had been. He later jokes that the GEICO profit dwarfed all the gains from every other deal he ever made. It is the perfect proof that one truly great, well-understood business can outweigh 100 mediocre ones. Graham retires wealthy and respected and dies in 1976 at the age of 82. By then, his ideas have quietly reshaped how the entire serious investing world thinks about risk. But his rules live on, quietly compounding fortunes for the disciplined investors who follow them. So what exactly can an ordinary investor steal from the father of value investing himself? First, always demand a margin of safety and buy a business for far less than it is truly worth. Second, treat every stock as a piece of a real business, never as a flashing number on a screen. Third, be the master of Mr. Market, not his slave, and use the crowd's panic and greed against it. Fourth, protect against being wrong, because Graham learned in 1929 that even the smart can be ruined. And finally, invest with discipline and patience, because his rules reward the steady, not the clever. Remember, too, that the market is a voting machine in the short run, but a weighing machine over the long run. And never forget that your worst enemy is not Wall Street or the economy, but your own fear and greed. You do not need to be a genius to grow rich. You need rules and the discipline to actually follow them. Graham handed those exact rules to a 19-year-old Buffett, who turned them into a fortune worth over $100 billion. And the very same rules sit today inside a $5 paperback that anyone on earth can read this week. That is the quiet miracle of Benjamin Graham. He took the secret of building wealth and made it almost free. Benjamin Graham took the worst financial disaster of his life and turned it into a gift for everyone. From the ashes of 1929, he built the rules that still quietly make ordinary, patient people rich today.